Welcome to our 2025 year-end tax planning video. This is going to be for calendar year-end tax planning for the year-end of 2025, obviously. So I'm going to kind of jump right in and just ramble through this, and hopefully this will be helpful for some of you. So we're going to start off with S corporations. If you have an S corporation, then you want to make sure that you've paid yourself reasonable compensation during the year. If you're not sure what that means, the law basically says that you have to pay yourself reasonable compensation if you have an S corporation. And that basically means that you cannot just take all distributions and no wages, because the distributions avoid self-employment tax and Social Security and Medicare tax. How you set reasonable compensation, if you ask 50 accountants, you'll get 50 different answers. But the bottom line of that is it has to be reasonable. So if you're making $250,000 a year out of your S corporation and you work there 70 hours a week and you pay yourself $5,000 of a wage, that's not reasonable. So you have to take all the facts and circumstances into consideration. But that's something that you should be paying attention to. You want to make sure before the end of the year that you've paid yourself a reasonable compensation amount out of your S corporation. Also, if you have an S corporation and you have expenses like a personal vehicle that you use for business, reimburse yourself for it before the end of the year. If you're going to charge the business mileage, don't bring in mileage records after the year end for your S corporation for the vehicle that your S corporation doesn't own. That mileage should be reimbursed if you're going to claim the mileage expense and you own the car personally and it's not on the books or being treated as equitably owned by the S corporation. So that's a common thing that people should be aware of when you're dealing with corporation or an S corporation. If you have expenses like mileage on a personally owned car, then you should be getting reimbursed for that mileage from your S corporation. Now that's different than equitable ownership. Equitable ownership is where the S corporation pays for all of the expenses of the vehicle and basically has all the burdens and benefits of ownership and is treated as being equivalent to the legal title holder, even though they're not. That's a whole different thing, and that's beyond the scope of this discussion. But if you are expensing the vehicle expenses through the S corporation because of equitable ownership, you don't need to worry about the reimbursement. Otherwise, you do want to reimburse yourself for mileage from your S corporation if you have a personal vehicle that you want to claim the business use of. Now, I should mention while we're talking about that, that would also include if you had cell phone reimbursements you wanted to do or any other type of expense reimbursement you want to do. That will bring up the issue of an accountable plan. An accountable plan is just accountant speak for you need to have a plan of reimbursement if you're going to reimburse yourself expenses from your company and your business. And if you're going to do that, you have to account for the expense to the company or the business, just like the business was accounting for that expense to the IRS. So you can't just make up a number and pay yourself for it. You have to have some documentation of some type. You can estimate on some things like cell phones. Cell phones are not listed property, which means that years ago the IRS took them off the list of property that requires special substantiation. And that means you used to have call logs and records for your cell phone. You still have to have records of the bill, but you can estimate how much of the cell phone is being used for business. So any expenses like that you want to claim in your S corporation, you should reimburse yourself for those expenses before the end of the year. Let's talk about pass-through entity tax payments. Pass-through entity tax is a new thing. I say new, it's a few years old in Missouri. Been around a little longer than that in some other states. Pass-through entity tax is the ability to claim through your business a deduction for state taxes paid by the business that are really your personal individual tax related to the income from that business, if it's a pass-through entity, hence the name pass-through entity tax. So that's going to apply generally to S corporations and partnerships. That's going to be a tax that if you have enough income for this to be worth your while, I don't generally recommend doing this if your income is really small, because it is another return that has to get filed. It's not a wildly complicated return, but if you have $5,000 worth of income, this is not worth playing with. If you do have income where this is worth messing with, you want to make sure that you make the payment for the past serenity tax before the end of this year if you want the deduction in this year. The way the past serenity tax deduction works is your company elects to be subject to state tax if it's a past serenity and otherwise wouldn't have been. And then it pays the state tax, and then you get treated as though your company was subject to that tax, and it gets a deduction for it. That deduction effectively passes through to you because the income is reduced that comes to you from the business. Then you get a credit for the amount of tax paid on your individual return. And that's all fine. But the deduction amount is what you paid in the current year. It's not the tax. So if you owe tax at the end of this year for past serenity tax and you pay it next year, you will get the deduction next year. So if you want the deduction this year, pay the past serenity tax this year. Now let's talk about bonus depreciation and Section 179 expense. These are fancy accelerated depreciation items where you can buy equipment for your business or other equipment-like assets. We use equipment most often because it has to be an asset that is typically personal property that's 5 to 7 years depreciation life, maybe sometimes 15 years, maybe land improvements and a couple other nuanced assets. But we generally talk about equipment. You can also talk about business vehicles with this, but I'll cover vehicles later. The purpose of this is we can accelerate depreciation, and bonus depreciation this year in the One Big Beautiful Bill Act is back at 100%. So you can claim 100% deduction for an asset that you place in service this year. It has to be placed in service. Buying it is not sufficient. Buying it and bringing the box with the asset in it back to your building doesn't count. The asset has to be placed in service. It has to be used for business before the end of the year. It has to be installed and used if it requires an installation. So if you buy a computer, the computer actually has to be taken out of the box and set up and plugged in and used for business. So I often tell people this is a great way to get some additional deductions if it was something you were going to do anyway. If you were going to buy equipment in February or March and you want to accelerate it to December, I'm all for it. On the other hand, if you're going to buy stuff you were never going to need, don't let the tax tail wag the economic dog. What I mean by that is we care about economics first. If it makes economic sense and we get a tax benefit, that's fabulous. If it doesn't make economic sense, the tax benefit is not very often going to make it make sense if it didn't make sense economically in the first place. So don't be driven solely by taxes. Make sure it makes economic sense. But if you're going to buy equipment anyway, then sure, put it in use before the end of the year and get a deduction for it. Bonus depreciation is back this year for assets that were purchased and placed in service after January 19th. If it was purchased before then or placed in service before then, it goes by the old rules. And the old rules were not 100% in this year. They were 40% in this year. So that's something to be aware of if you're dealing with the bonus depreciation deduction. Section 179 and bonus are a little bit different. Bonus is just a depreciation deduction. It's just accelerating the depreciation. You can have a loss with bonus depreciation. Section 179 expense, you generally can't create a loss with it. The other thing to be aware of with these, I caution people if you're purchasing a financed asset and you're going to get a 5-year loan or something like that, and you're going to accelerate the deduction this year, a couple things you need to be aware of. One, you're going to have the burden of that loan payment for the next few years, and there's not going to be any tax deduction for it because you're taking the tax deduction this year. So in the remaining years, you're going to need to generate enough cash flow to pay the tax on that cash flow and make the loan payment. So let's say your loan payment's $1,000 a month. You're going to need, let's say, $1,300 a month of available income to pay $300 in tax and $1,000 to the loan payment, because you will be getting no deduction in year 2 through 5. All the deduction is coming in year 1. Another thing to be aware of, if you hurry up and accelerate deductions using a financed purchase and you're an S corporation, you may be trading out one type of tax for another. And what I mean by that is, if you've taken a lot of distributions of profit and you use bonus depreciation or Section 179 expense to significantly reduce the profit, and that deduction came from financing, meaning you didn't pay out, you bought a $50,000 piece of equipment, but you only put $500 down at the beginning of December, got the thing delivered and installed, and are using it, and got a deduction for $50,000, but you only paid $500. That is a wonderful little tax deduction in that year. But if you've taken distributions out, we might just reduce the profit by that deduction to the point that your distributions are now in excess of the retained earnings and profits of the company, and you can then create a taxable distribution in excess of basis. So be aware in the S corporation that you have to pay attention to what you're doing with that, because you can create a different problem that you might not otherwise be expecting. Let's move on to C Corp bonuses. If you're a C corporation, we usually in the past have wanted to get your income down in the C corporation because the tax rates graduated. Now you can still want to get money out of the corporation and want to get the taxes down in the corporation, but the corporation nowadays is at a 21% federal tax rate that's flat. So there's less incentive to drive us to want to make that number go down a lot. But that is still there. If you do pay the corporate bonuses, be aware that they have to be reasonable. It has to be reasonable compensation, just like in the S corporation. And you need to be able to justify the compensation if you get audited. The IRS can try to assert that those were disguised dividends. That comes up typically if you're paying them right around year end and you don't pay bonuses any other time of year and it's just the owners who are getting paid and it's a lot of money compared to the profit of the company. The IRS is probably going to presume that that's a disguised profit distribution, otherwise known as a dividend in the C corporation world. And so under audit, that could be recharacterized. Charitable donations. If you're going to do charitable donations, itemized deductions are a tricky thing these days, so this would only apply in your individual return. You can do charitable donations on your business returns. C corporations, there's a limitation on that having to do with your income. S corporations, partnerships, sole proprietorships, that's all going to be claimed on your individual return as an itemized deduction. And that's where we're going to get into, if you're going to do this, a couple ways of doing charitable donations. One, the most preferred way, would be if you have any required distributions from a retirement account, you may be able to do a qualified charitable donation out of the distribution. And that would be something worth considering. There are specific details to that. You need to make sure you comply with that. It has to be the right type of retirement account, and there's a limit. But that is one of the preferred ways of doing that. Another thing you can do is bunch your charitable contributions. So in year one, we give $50,000 to charity, and in year two, we give nothing. And that's presuming that you were otherwise going to give $20,000 or $25,000 a year to charity. The purpose of that is 1 year I'm going to have enough charitable deductions that when I add my other itemized deduction possibilities, it now makes sense to itemize. So you can do that with bunching. You can also do that with a thing called the donor advised fund. The donor advised fund allows you to contribute money to a fund that will then dole that money out to charities at a later date. I don't really find the benefit of that because you're going to give all the money away now. You might as well give the money away to the charity. But some people like the donor advised fund, so that's just a thing I'll make you aware of. Let's move on Defer income or prepay expense. You can defer income if you have a business by effectively not billing your customers. So you can delay billing some work and effectively delay income. Notice I did not say you can delay making deposits. Once you have received money, it does not matter whether you've deposited it in the business bank account. If you have it, it's income. If you have dominion over it, it's yours. Now, some people operate under the theory that, well, I'll just wait and deposit it next week or the first week of the next year. You have to be careful with that because it's obvious. Let's say that I don't deposit any money for 3 weeks in December, and then in January 5th, I deposit a month's worth of sales. If I'm an auditor looking at that, it's kind of obvious, isn't it? Let's say you even waited a bit, there's this one or a couple really significant deposits in the next month. That's why I say, if you're an auditor, it doesn't take a lot to be able to see that. Deferring the billing is different than deferring the deposit, because the deferring the deposit has to do with the fact that you've received the money. And this is a thing also, there's a thing called constructive receipt. If somebody was already in process of paying you and you tell them, hey, don't pay me till after the first of the year, you were effectively paid. You had control over the payment. So now if you haven't billed them and they weren't planning to pay you, then there's no problem with that. So same thing with prepaying expenses. You can prepay many expenses. There are certain expenses that don't qualify, but a lot of expenses you can prepay. You can't prepay more than a year's worth, but that is something that may work in some circumstances. So that's deferring income and prepaying expenses, but be careful with how you defer income. Max out retirement account contributions. If you have a retirement account, such as a 401k, simple IRA, a SEP, any of the other types of retirement accounts, or on your individual return, if you have a traditional IRA or a Roth IRA. It's good to consider your available options for maxing out your retirement contributions. And if you are employed at an employer that is matching on a simple IRA or 401k or something like that, then you almost always want to participate in the matching contribution. So that's the retirement accounts. While we're talking about retirement accounts, let's make sure if you're of retirement age, and now it's not just being retirement age, there's a certain age now. It used to be 70 and a half, but now it varies a little from 70 and a half, I think up to 73, for starting required minimum distributions from your retirement accounts. If you are of age to be required to distribute money from your retirement accounts, make sure that you take the required minimum distribution. There are penalties for not taking the required minimum distribution, so I just want to get that in. If that's you, make sure that you're aware of that you've worked with your financial advisor to make sure that that money is being withdrawn and pulled out. All right, so moving along. Home office expense. I covered this a little bit. We were talking about S corporations, but I'm going to talk about home office expense specifically. You got a couple options for how to claim home office expense for your business. You do have to have space that is exclusively used for business to claim and deduct the home office expense. If you have an S corporation, the S corporation doesn't have a home office. You individually can, and you can reimburse yourself from your S corporation for the actual expenses of your home office expense. And if you want a quick little trick for how to do that without having to do a whole lot of paperwork, because otherwise you have to allocate the expenses of your home, the operating expenses of your home, utilities, mortgage interest, real estate tax, all of the expenses of your home, insurance, lawn care, repairs. You have to allocate those to the portion of the home that is being used exclusively for the home office. And let's say that was 8% of the home, then you'd allocate 8% of those expenses plus the depreciation on the property. But There is a simplified method where you can take $5 per square foot for up to a maximum of 300 square feet, and that's for the year. So if you had 100 square feet that you were using, then you could pay yourself $500 for home office expense and just reimburse yourself from your S corporation, for instance, and write yourself a check for that. You still have to have a qualifying home office. That means it has to be a place that is exclusively used for business, and it has to be a principal place of business. Now, to be a principal place of business, if it's the only office you have, great, it wins. If you have another office, like I do, right now I'm filming this from my studio at home, but I have an office on Hampton. There is another thing you can use called the administrative home office exception. The administrative exception basically says that this is the principal place where administration is done. So if there are activities that you principally do at your home office that you do not do regularly at your other business location, then you may qualify for an administrative home office. The advantage of the home office is once you have paid yourself for a home office or claimed a home office, sole proprietorships can claim this directly without the reimbursement. S corporations need to reimburse the home office. There's no way for an S corporation to directly claim home office expense. C corporation would be the same thing. C corporation would need to reimburse the owner for the home office expense. So one of the benefits of the home office expense, though, is if you have a home office and you get up in the morning and you go to your home office, and then later you leave the home office and go to your main office, you have now converted that drive to business mileage, because now you are going from one place of business to another place of business. Your commute was walking down the hallway in your house. So that's an added benefit of the home office expense, is it can unlock additional mileage for the vehicle expenses. And that is the perfect segue in the vehicle expenses and mileage records. Vehicle expenses, it's always a good idea to try to maximize the deduction for your vehicle expenses, because most likely you were going to own a car anyway. However, the government's kind of on to that, so they're pretty specific about, one, you're going to need mileage records, and then you have a couple options. You can reimburse yourself at the mileage rate. Just take the number of business miles that you've driven, multiply it by the mileage rate, and if you're an S corporation or a C corporation, you can reimburse yourself personally for that number. That's presuming that the company does not own the car. You cannot reimburse yourself for driving the car that the company owns. If it's a personal vehicle being used in business, then you can reimburse yourself for it. I mentioned having mileage records. The mileage records need to be contemporaneously maintained. That means they need to be maintained at or near the time of the driving. You cannot reconstruct them later, and if you get audited and the IRS believes you reconstructed them later, they will disallow the expenses, and they have succeeded at that in court. So you need to keep good mileage records. I recommend an app called MileIQ. There are other apps. There are probably several of them that are good. The trick is to have the records. I don't care whether you manually have the records. I don't care if you have them on your phone, an Excel spreadsheet. For my mileage with my bands that I play in, I keep an Excel spreadsheet. I update it pretty much every week so that I list where the show that the band performed was. I list where I left to go there and what the mileage was from one point to the other in that spreadsheet. And I compute the mileage rate. And now my band activity is done as a sole proprietorship, so I can just deduct that. I don't have to reimburse it out of my sole proprietorship. But that's something to be aware of. You need to have mileage records. This is also true if you have vehicle expenses in an S corporation or a C corporation where the company owns the vehicle. If the company owns the vehicle and you have personal use of that vehicle, you are, in most circumstances, required to report the personal use of that vehicle on your W-2. To report the personal use of the vehicle on your W-2 and to substantiate the business use of the vehicle, you're going to be required in most cases to have mileage records. I say in most cases because there are some exceptions for things called qualified non-personal use vehicles. Trash truck would be a perfect example of a qualified non-personal use vehicle. If you have a trash company and there's a trash truck and you drive the trash truck home and then you drive it back to work, the IRS is presuming that that's qualified non-personal use. Nobody in their right mind is typically driving a trash truck around personally. So that doesn't mean it doesn't happen. That does mean that you don't necessarily need to have mileage records for the trash truck. For most typical vehicles, you are going to need mileage records. If the company owns the vehicle, the personal use value should be added to your W-2. If it's not, and you get audited, the IRS can have issue with that. You also have a little bit of trickiness about how you deduct the vehicle that's owned by the business if the personal use value is not being picked up on the W-2. So you want to make sure that's being done right. And I think that's pretty much everything for vehicle expenses. Let's move on to HSAs. If you have an HSA, that's a health savings account, then that is worth maximizing the funding of the HSA. With that said, if you have a health savings account, make sure that that health savings account is associated to an appropriately qualifying high deductible health insurance plan. I see this all the time where I talk to someone and they have a health savings account, but they don't have an underlying high deductible health insurance plan. Maybe they did when they opened the account. Maybe they didn't, depending on how thorough the people were at the bank or the facility when the account was being opened. But things change and people change insurance plans, and then they don't realize that you changed your insurance to a more full coverage insurance plan with a lower deductible and lowered your deductible right out of the health savings account standards. And that doesn't mean you can't continue the savings account you have, but it does mean you can't contribute to it. So that's a problem to pay attention to. I'm going to move on to talking about rent and the Augusta rule. I'm going to talk about rent in regard to a business, and this is going to talk about the self-rental rule a little bit. So this is only going to apply to business owners that own their own building. You own your business and you own a building that you rent to your business. And you can't be a sole proprietorship to do this. If you're sole proprietorship, you can't rent from yourself. But if your business operates as an S corporation or a C corporation, it can rent the building from your sole proprietorship or your partnership. Typically, for tax purposes, you're going to have real estate taxed either at sole proprietorship or partnership level. And while we're talking about that, I will jump into, I can hear voices yelling at the screen, I'm an LLC. If you're an LLC, that's a state law entity selection. That's not a tax selection. So LLCs, for federal tax purposes, become either sole proprietorships, partnerships, S corporations, or C corporations. They default to the treatment they would be if there was no LLC. So they default to sole proprietorship or partnership treatment. They can elect to be S corporations or C corporations for tax purposes. So you have a business and you have a building and you rent that building to your business. There's a thing called the self-rental trap. And the self-rental trap is that the rental income in that scenario, unless you've done a grouping election, and I have done grouping election with some clients, but if you haven't done a grouping election, the self-rental rule basically says when you have a loss in that rental situation, that loss will be a passive loss and be limited by the passive loss rules. When you have a profit from that rental situation, that profit will not be passive. So that's to prevent you from having other rental property and manipulating your rental income up on your business property to create income to offset your other passive losses against. That's why the rule exists. I'm just making you aware of this because if you are operating in that scenario where you have a building that you're renting to your company, good idea to rent it at a profit. If you're renting it at a profit, then you won't have a loss that's limited in that scenario. And the business that's paying the rent, if it pays an increased amount of rent, is going to get a deduction for the rent, and then your real estate holding activity is going to have income, and that income may be taxable, but it's only taxable because we reduced the income of the business. So they kind of offset, but they don't offset if you have a loss. The activity renting the property to the business is doing that at a loss. You can end up with that loss not being deducted. And so that's why we want to make sure we're renting at a profit if we're renting to our own business, unless we have a grouping election. That same thing is true that you can do cost segregation studies. That's a little outside of the scope of this video to accelerate deductions on property when you're talking about real estate. But you want to be careful with that if you're not familiar or haven't worked with me or an advisor in the capacity of dealing with how you're going to maximize the benefits of a cost segregation study. That's outside the scope of this year-end video, but it's just something worth mentioning. So that's the self-rental rule. While we're talking about that, we should talk about the Augusta rule. The Augusta rule is basically a rule that says if you rent your home for less than 14 days a year, then that rent is tax-free. Well, you can rent your home to your business, and you can have some key business meetings, a board meeting. If you have a corporation, you should be having a board of directors meeting anyway. So if you want to have a board of directors meeting and a shareholder meeting at your home, go look at what a conference center or a hotel charges for use of their facilities for a meeting similar to the duration or circumstances the meeting you intend to have. You do want to document this and then pay yourself rent for the use of your home from your corporation or your S corporation. And you may end up with at least a little bit of tax-free money. This is not going to be earth-shattering, but it's still some tax-free money. So, but it has to be a legitimate meeting. It has to have a legitimate purpose. If you're audited, the IRS is going to want to see proof that this was a legitimate meeting and the amount paid is legitimate. There are all kinds of cases on this where people got really crazy and paid themselves $50,000 of rent. That's probably not going to fly. It's going to be interesting to try to assert why you needed to spend $50,000 to have a meeting, especially if the meeting was 2 or 3 people. So just keep in mind that we want to be reasonable and we want to have documentation if we use the Augusta rule. It's called the Augusta rule, if you don't know, because years ago at the Augusta golf tournaments, in Augusta, I should say, the golf tournaments that were in Augusta, people would fly there and people would rent their homes for the week because they could get a lot of money for renting their homes. And they would rent their homes and people would stay there. And then they operated under this tax provision that said if you've rented your home for less than 14 days, then you don't have to pay tax on the income. Well, the rent was pretty big and there were IRS audits, and the IRS went to court with one of these taxpayers denying their deduction. And the court said it doesn't matter how much the rent is. What matters is 14 days or less. Now, it does matter that the rent be reasonable, but this was a high demand circumstance at that time. So anyway, that's where the Augusta rule was born. That's why it's called the Augusta rule. Moving along, 529 plan deductions. That's education plans, the state 529 education plans. If you are so inclined to be contributing to those, make sure you get your contributions in before the end of the year. Paying children. If you have a business and you have children who are under 18, they can be over 18, but if you have children who are under 18 and you can come up with things for them to do in the business, it's a good idea to pay them out of the business and get a deduction for it. Now, if it's a sole proprietorship, you can avoid the Social Security, Medicare, and unemployment taxes. So there's a pretty good incentive on a sole proprietorship to want to pay your children. In an S corporation or a C corporation, you can still pay your children. You will not get that benefit. There is the possibility of having a sole proprietorship that is paid for from the S corporation or the C corporation, and then you pay your children from that sole proprietorship. That's getting pretty involved, and you need to have an advisory consultation with me or someone like me that is setting that up. And in my experience, depends on circumstance, but it's not always worth, the juice is not always worth the squeeze, to quote my business coach on that one. Sometimes it's just better off go ahead and pay the children out of the S corporation or the C corporation. The advantage of paying the children ultimately is your business is getting a tax deduction and you're getting a tax deduction, and your children are having effectively tax-free income because they're probably not going to have more income than the standard deduction. And they can then use that money to pay for things that you otherwise were probably going to pay for. If they're going to soccer or hockey or dance, and you want them to pay for soccer, hockey, or dance, then if you've paid them from the business and they've done legitimate work, they have to do legitimate work, and the wage has to be reasonable for what they're doing. So, and you have to comply with all of the laws. Well, as long as you've complied with all the laws and they are legitimately working for the business, then you can pay your children and get some deduction out of paying your children, and they're very likely not going to be taxed on it. And the point of all of that is, as long as they're doing work, we're just moving money around and getting a deduction for it, for things you were going to pay for anyway, because you were going to pay for the expenses of that child. So if that child now earns income from the business and the business gets a deduction from that, that's great. And then the child is not at the rate of having enough income to be taxable, then they're not going to have tax on that. Now again, C corporation, S corporation will have Social Security and Medicare tax on that. Sole proprietorship will not. Partnership will not either if the partners are only the parents of the child. If the only partners are parents of the child, that works. And for our final point, clean books. One of the better things you can do in order to have really great tax planning and good tax results are have clean sets of books. And by that, I mean, if we're maintaining your books, give us good information, give us timely information, respond to our questions on a timely basis. And if you're maintaining your own books, keep them well and pay attention to detail. So having clean books is useful for many reasons. One, it helps protect you if you're audited. Two, it gives us very good numbers to be able to talk about the performance of your business with you. So if I have messy books, I have messy advice. If I have good books, I have good advice. It's the old garbage in, garbage out. So the better job that we can do maintaining books, and the better job you can do maintaining books if you're maintaining the books, then the better we are able to help you. So that's pretty much my year-end tax planning guide. I just thought I would put a video together for our clients and friends so that you would have me rambling for a little while, telling you what things might benefit you from a tax standpoint. So I hope this was helpful, and thanks for watching.